in sort of preparing the material for presenting this, the biggest challenge I faced was this is a difficult topic to condense in a 1.5 hour session. And I was not sort of exactly sure in terms of what your specific, areas of interest are, what you're sort of currently looking at, which is why I say, stop me at any point, sort of throw up a question and I'll try to answer it as we go along. Investing is probably one of the most, misunderstood concepts. In the sense that one is you are constantly bombarded by media, so all the time you're listening into things from, it could be, your phone, your Instagram feeds, your Facebook, whatever you use, your, Bloombergs and CNBCs and TV and so on. But at the same time, it's a very personal game. Investing is highly sort of personal. And as I go along, I'll try to explain to you why this is very simple, but it's not easy, is what I will try to sort of, explain to you, over the course of the slides. My job basically entails dealing with, high net worth, ultra high net worth, sort of all kinds of individuals. What they what they come to me for is really to sort of seek advice in terms of, finances generally and sort of other things also. And what I've learned over the years is investing is many times 90% psychology, 10% finance, maybe 95% psychology, 95% psychology, 5% finance. Okay, why is that the case? We'll again come to that later. Again, sort of to reiterate, please feel free to, stop me at any point. I might sort of seem to be diverting here or there, but hopefully by the end of the presentation, the whole sort of thread should link in together. So what I propose to do is here, I'll first start by talking about really what is sort of investing all about. Then we will go into investing strategies. Investing strategies, again, sort of some of you, might be very familiar, some of you might not be familiar. The interesting part about investing is really 101. In the sense, it is actually very basic. 99% of mistakes that I have seen over all these years is very, very basic mistakes. Very basic mistakes. So for example, it's like a world-class soccer player shooting a penalty wide, when they could have shot penalties with their eyes closed, to give a soccer analogy. But when it actually came to doing that, it was a completely different sort of matter. That is sort of what investing is about. So investing strategies, there are sort of different strategies you can look at. What are the rules of investing? In the sense, simple rules. If you follow those rules, you will be fine. In fact, I would again sort of, divide this into two categories. There will be some of you who would be interested in looking at this through various aspects, and I'll give you sort of hints and tips as we go along, what you can do about it as a sort of ordinary, again, in inverted commas, investor, what you can do. There might be some of you who would say, look, I don't want to do any of this. Okay, I want to be a professional athlete. I want to be an MBA student. I want to be a CEO. I don't have time for this. What do I do? I'll tell you later on sort of how you can do very well even with something like that. So I'll present both these scenarios. Market cycle psychology. Again, market cycle psychology is where this happens repetitively again and again. I've always felt history is a subject that should be taught right through the time sort of your formal education ends, because really history is critical. History is very critical. So for example, a lot of you who might have, either have friends investing, you invest, whatever, the general feeling is 2022 was a terrible year. It depends. 2022 was not a terrible year. In fact, 2022 would have been absolutely fine. But why do people say it was a terrible year? Why did so many investors lose money in 2022? What were the sort of reasons? We can sort of, we'll go into some of those details, time permitting. Some of it we could sort of cover, question and answer session also. In terms of asset allocation is again, something that is at the core of investing. Now, asset allocation is again very controversial, because as I will sort of show you later, there are investors who say asset allocation is nonsense. There's nothing like asset allocation. This is one topic on which you can have an entire 6-month course on, what is asset allocation? How do investors actually allocate in practice? How do we build portfolios for clients? That is sort of asset allocation. So we'll come to that later. And lastly is, okay, given that, you have been sort of sitting here, you have spent an afternoon, you've sort of given up either an afternoon of study or an afternoon of siesta sitting here. What have you got from it? What should you do now? My objective in, making sort of in doing this before students is, I really feel you have, one is, managing personal finances well is something which every person should be able to do. It's not difficult. It's not complicated. If you get the basics, it's absolutely fine. The second thing, which is very, very critical, it's one advantage which all of you have and which I don't have and which most people of my generation would not have, is you have a very long investing runway ahead of you. There is absolutely no reason to believe that some of you, all of you, one of you, whatever, would not actually turn out to be an investing superstar, because you have a 20, 30, 40, 50 year investing runway ahead. This is a critical difference. I mean, I cannot overstate how important this is. So for example, I will make a lot of references to Warren Buffett as we go along. Okay, you would have heard of Warren Buffett as one of the greatest investors. what people don't realize is the sort of the legend of Warren Buffett, the genius of Warren Buffett, that really sort of, it started shining, it came about into his 50s. So a stock like Coca-Cola, which he mentions many times in his speeches, it was actually, he did not buy a single share of Coke till he was around 52, 53, 54. That was the first time he actually purchased Coke. And he in fact regrets that, saying that I should have done this 20 years earlier, 30 years earlier. Why did he not do it? There are many reasons for that. But from the age of 54, currently he's probably somewhere in his 90s, maybe 1991. He has had that investing runway for 30, 40 years. And he has sort of built Berkshire Hathaway, and depending on how closely you follow the company stock price and all, to a phenomenal level. So all of you here have that investing runway ahead of you. Even if you make mistakes, it's fine. You will have time to course correct and get back. So that's a very, very powerful advantage that you have, which very few investors have. This was searching for returns. This is, the latest sort of copy of The Economist. It's again sort of when I mention something, it's not like I'm recommending it, but it is something which I feel that if you'd like to learn more about this, it's definitely worth reading. So The Economist is a publication which is certainly sort of worth reading for general investors, general knowledge, whatever. Searching for returns. When a client walks through the door, what the client essentially really is walking through the door for is returns. When you give money, when you put money in a bank, what you are implicitly, explicitly asking for is that the bank should give you returns. Maybe 0.5%, maybe 0.1%, maybe 10%, whatever. When you make any asset purchase, when you make any investment, what you're actually asking for is returns. The basis of investment is returns. When a client sort of walks through the door, the first thing the client is asking us, even if he or she might not ask us straight away, is basically saying, so what returns will you get from me? That is sort of really, really the question. What I would urge you to do is, you may listen, you may read, make your own judgment. Investing is a very, I don't want to use the word lonely because it's sometimes seen in a negative connotation. Investing is a very personal game. The best investors are people who probably lock themselves in a room and think. That is all you need. Investing is not a team sport. Okay, it's not, I have nothing against investing clubs. They are good for knowledge, they are good for information, but investing is not a team sport. Investing is a sort of lonely sport. Don't be afraid to take a decision that sounds completely sort of off the charts, that sounds sort of completely wild, provided you have the conviction to go behind a decision. In a lot of cases, I can absolutely guarantee you in the real world, clients don't have the conviction. They say they do, but they really don't. And, we deal sort of, the way I'll put it is bank accounts never lie. That is actually the test. That is the sort of the real sort of where the rubber hits the road. You must have heard that saying sort of, put your money where your mouth is. Okay, so that is where you find if you have conviction. So for example, again, if I were to just throw out a random example, say something like Tesla. Again, sort of, I don't sort of recommend, I'm not putting buy, sell anything on the stock. But what I'm saying is, it's something which a lot of people in Hong Kong discuss. Okay, should we buy it? Should we sell it? Whatever, view on Tesla. Conviction is where you would decide what to do and you would go in and then you don't really care what other people think or say. That does not happen to 9 out of 10 investors. And when I say 9 out of 10 investors, I'm talking about 9 out of 10 investors whom we deal with. These are very, very smart people, very smart. So the general level of conviction in investing is extremely low. People would change their minds between morning and evening. Okay, that is not conviction investing. When a client walks through the door, the first thing the client is really looking for is searching for returns. What we sort of, what investors are trying to do is they are trying to build a portfolio. Portfolio construction is, it's not a sort of, it's simple, but it's not easy. Okay. When you construct a portfolio, one is you would have an inherent bias towards some asset class. So for example, now if I were to ask a question, if anyone here wants to answer, what asset class are you familiar with? What I mean by familiar is you might have invested a little before. You have a friend, an uncle, a parent, whatever invests. What asset class are you familiar with? Just as an example, if anyone would like to say. So when you say FX trade, it's any sort of currency, right? Whatever, pound, dollar, anything. Okay. So now FX trade. So I'll give you FX trade is a very good example because let's talk of 2022. Okay. People say 2022, nothing happened, terrible year, bad year, whatever. In 2022, a major currency, or sort of, one of the world's premier currencies, like the pound. The pound fluctuated within sort of, I'm talking of like, 12 calendar months, 1st Jan to 31st December. The pound fluctuated roughly maybe around about 35 to 40%. That is an enormous fluctuation for a major currency. So the pound at one point had gone down to as low as 1.0345. So say whatever, say it, coming down to pound dollar parity. At the other extreme, the pound had gone to 1.37. Okay. In the span of 12 months, this is the pound. Every sort of asset class each year, almost unfailingly, will give investors an amazing opportunity. This, if you look at sort of history over the years, I can guarantee you This has happened each and every year without fail. Good years, bad years, whatever. So the next question you'd ask is, why didn't people, for example, buy the pound at 1035 and sell at whatever 1.37, right? Such a big change, 40% in the year in which you say investors lost so much money. Why didn't people do it? Now, let me sort of tell you the practical thing. Okay, I'm sort of diverting a little here from the topic. So on the sort of, on the trading desk sort of where we sit, I mean, I remember when Brexit had happened, the pound had gone to about 1.15, the pound to the dollar. A lot of investors by this stage were in a fairly panicky situation. In the sense, they were saying that, look, on one hand, the pound looks really cheap. Maybe we should buy the pound. 1.15 is fantastic. Will it ever come to those levels? But on the other hand, what happens if it goes to 1? What happens if it drops another 25-30%? So this is a major asset class which is heavily traded, which is extremely volatile, which is giving you a phenomenal opportunity with a lot of liquidity. Should you do it or should you not do it? This is what I mean by conviction. Okay. Now remember, conviction can go sort of right or wrong. Okay, conviction doesn't mean you're right. Conviction is conviction. I mean, you do something because you believe in it, whether it's sort of right or whether it's wrong. This is sort of one example of an asset class. So there each year, there might not be many, there will be few, but there will be few significant opportunities. And similarly, like the sort of pound, I could say also talk about a yen and so on. Okay, so and this happens almost every year. The problem what happens is with most investors is their minds are all over the place. They are looking at many, many different things. What I tell my clients is shut down your CNBCs, shut down your Bloombergs, do not watch any of this. Watch it for entertainment. If you are telling me I'm watching it because I enjoy it, do it. I mean, do whatever you enjoy. But if you're going to listen to that and then come back and tell me, let's trade, don't do that. Okay. So watch it for fun, enjoy it. If that's your Saturday evening fun, Friday evening fun, go ahead and do it. But don't convert that into investing. It may not pay off. Again, sort of these are great channels. I'm not recommending for or against, but don't confuse that with investing. It has got nothing to do with investing. So building the portfolio step by step. I mean, this is literally managing the portfolio. Portfolio management is important because people panic at all the wrong times. Okay. A lot of investing is, I would say it as keeping your cool. I can't sort of find a better phrase to keep it, but I'll say sort of keeping your cool. Because again, investing, you need to be very calm-headed. That's why I say it's a lonely sport. It's not something, you can't get 100 people in a room and decide. So what happens is, most sort of major houses, private banks, wealth management companies, they have investor conferences. And these are normally held, you would normally have them quarterly. They haven't been held, 21, 22 and all because of COVID, but they will be normally held quarterly, at which we conduct polls. And the polls are typically, what do you expect? Say, for example, what would you expect? How would you expect markets will perform this year? And remember, this is a room of clients who are sort of from reasonably wealthy to very wealthy. Investors who have been investing for a long time, fairly well informed about the markets and so on. Almost consistently, they get it wrong. When I say they get it wrong, I say we get it wrong. We all get it wrong. The reason is that the markets will always be ahead of you. However good you are as an investor, the markets will always be, a few steps ahead. So accept that, learn to use that to your advantage, and then sort of play that. That is what I mean. The minute it's exactly like, I don't know if any of you are into mountain climbing, mountaineering. You can never really conquer a mountain. I mean, you can climb a mountain 10 times, if you're lucky, you survive all the 10 attempts. Beyond that, really, you can't do anything. That is what sort of investing is all about. The markets will be significantly ahead of you. What I would tell you is, go back, you can maybe write in your diary 3 or 4 things you think will happen, 4, 5, whatever. I'm almost sure none of those will happen. Something else that you've not written will happen. And this will happen to each of us. Even if I were to write it, it's the same thing. That is the way sort of, the world works, the way the markets move. So when I say managing the portfolio, a lot of it is really kind of hand-holding the client, making sure that the person is okay. We get sort of, calls saying that I can't sleep at night. Okay, that's another common thing. I have got, the client, the sort of lady, gentleman, whatever, money, cars, property, wealth, travel, cannot sleep at night. Okay, because of this sort of constant, television on 24-hour, markets on 24-hour, news feeds on 24-hour. And the way Hong Kong is, so for example, you wake up in the morning, Tokyo is 1 hour behind you. Tokyo has started trading. You get into office in Hong Kong. Hong Kong, Singapore has started. Okay, by the time you're through with your lunch, London is open. Okay, markets today are sort of, they are all across. Trading is across. Okay, London is finished in the evening, then sort of the US will open. By the time the US shuts, it's midnight. It's time for Tokyo to open. Okay, so the markets are on a 24-hour cycle. Earlier on, you could have said that it doesn't matter. We don't follow it. Today, news is absolutely instantaneous. Literally, the minute something happens, it will be flashed into your, your smartphone, your WhatsApp chat, your, whatever, Snapchat, Instagram, and the whole world will come to know of it. Within less than 5 minutes, the market should have adjusted. It is absolutely rapid, and that is what sort of keeps people on edge. The feeling that, we can't be 1 hour late, we can't be half an hour late, we are sort of behind the news, the event has already happened. Okay, so that's managing the portfolio, managing the relationship. I won't sort of get too much sort of into this, that's another topic by itself. Basically managing the client and what clients really want. What clients really want, frankly, at the end of the day, is to be able to sleep peacefully at night. That is the simplest way I can put it. That is really the wish of all the clients. that they can actually have a good night's sleep with what they have got. I'll give you examples later when you go on the slides about things that have happened in the past, and what you can learn from them and the mistakes that the best of investors have made. Have any of you read any of these books or heard any of these books? I mean, heard about any of these books? Intelligent Investor. Okay, what have you what is your? What have you heard about it, or what? Just
like,
right.
It's more like strategy on how to invest, what
right.
timing and what time of quantum, like how much you should invest. The quantum is less discussed right now in the market, but this book also could discuss about how much and actually how much you should invest.
Right. I put up these 3 books. The reason why I put up this slide is basically that if you want to be a good investor, what I would suggest is you don't do anything for 1 year. Okay. Now your reaction to that obviously might be, look, that sounds a bit odd. Here you're sort of talking about investing, and now you're saying the reason why I'm saying this is before you actually do anything, start learning a little, start reading a little, and start getting interested a little. That itself will put you in a very good position. Opportunities will come every year. I see this thing being mentioned, repeated many times, and I don't I don't like it. I don't agree with it. Is that it's, oh, you missed this opportunity. In investing, I can absolutely guarantee you, in the course of your investing lifetime, you will see a minimum of 2 sort of spectacular, asset market crashes. What I mean by spectacular is at least a 50% decline of anything you have in your portfolio. I can guarantee you this without knowing what is in your portfolio. Anything you have in your portfolio will, over the course of your investing lifetime, decline by at least 50%. Okay, regardless of how solid it is. So in the course of what I've sort of seen in investing, things like, for example, later on we'll talk about Russian default. A default by Russia was unimaginable when it happened. It was absolutely unimaginable. Okay, and I'll explain later the reason for that also, why it was so astounding and why it got the world's best investors completely shocked. It basically stunned the world's best investors. Okay, so something like that. I think about 2 or 3 years ago, Lebanon sort of defaulted. Never happened before, not in the last 50 years, through all the crises, whatever. In investing, you never say never. Okay, that's sort of one thing. Now, what do these books do? These are the books that I like. Okay, so they are not books that I'm saying that, you should be reading them if you want to be an investor. There are lots of different things about investing. These are the books that I like. These are the books that I have read. And these are the books that I find interesting for the following reasons. The first thing about the intelligent investor, Benjamin Graham, is the concept of investing. So Benjamin Graham, he basically, I would say Benjamin Graham became more famous because Warren Buffett, who's one of the most famous investors, refers to him all the time. So Warren Buffett has, in fact, I don't know whether you can read this from here. He says the top is Warren Buffett, by far the best book on investment ever written. In a way, this is also actually true. Ben Graham talked about very simple investing principles. And really, if investors followed those principles, they would have been absolutely fine. The only thing is, because it's sort of fairly simple, it's like the sort of, it's simple, but it's not easy. So everyone understands if you read the book, for a lot of you, frankly, where intellect is concerned, intellectually, you are way above what investing requires. The intellectual capacity that you all have is much higher than what you need to become a very successful investor. The problem will not be your intellectual capacity. The problem will be the market psychology. The problem will be the simple and sort of easy. Okay, so the intelligent investor, Benjamin Graham, where he talks about the basics of investing. This book is referenced repeatedly by Warren Buffett. He keeps on speaking about it. And this is what led to the growth of value investing. Now, again, I'll ask you a question. Are you, value investing versus growth investing? Is this something you have heard about, read about, any views, anything at all? Anything do you prefer value investing, you prefer growth investing, or anything, any ideas, any thoughts?
I like the value investing because we can find the undervalued stock and invest in and just wait a couple of days, a couple years till the stock make the stock improve.
Right. Okay. You're right. Value investing is generally concerned with what is the intrinsic value of a stock. Okay, that is value investing. Now, if you ask me personally, I don't believe in value investing or growth investing. I believe in what, again, later on, I'll come to what, I won't show you that video clip of Warren Buffett because it'll be going into too much of detail. But basically what he says is that all investing is value investing. The reason being simply, would any of you invest in something if you didn't see value? Some people might say, look, this offers tremendous value. I have done an analysis of the company. This stock is worth more than 200. Okay. A value investor could look at it from a value point of view and get a value of 200, saying that, you're really underestimating future cash flows. A growth investor will say, look, this is not even 200. This will go to 400. You have no idea what kind of demand there will be for the products that this company is making. Okay. Growth investors, generally, they are looking for the word growth, while value investors try to find what is the intrinsic value. If you ask me, there is no difference. All investing is value investing. I have not found a single investor whom I told him there's no value in this stock and the person says still, I think it's great. Okay, so all investing in that sense is value investing, but again, make your own opinions, sort of form your own judgments, and there is nothing like right or wrong. In investing, the best part is the market is the referee. It's like playing a soccer game. Okay, who's going to win? I may think I won the game, doesn't matter. What decision has the referee given? The game will be decided on that. The market is always the referee. Always sort of remember that. The little book that beats the market. This is by a professor from Columbia University, Joel Greenblatt, who also sort of runs his own fund called the Gotham Fund. It's an interesting name. I don't know if any of you are fans of Batman, but I think that's probably where he got the name, Gotham Fund from. But Joel Greenblatt, the interesting thing about this book is he has literally written it so that even a school student can read it. And the reason why he wrote it that way is because, again, he believes that investing is simple. I mean, it's not easy, but it's simple, and there is no reason to complicate it. Okay, and he's a professor at Columbia Business School, and again, sort of these are people who's, depending on your interest, your time, your inclination, what you want to learn, even their videos are very interesting to hear. Okay, I mean, I find them very interesting. I'm not saying, you might find them interesting, but if you want to learn more about investing, these are definitely some of the people you should sort of listen to. So what I tell my clients is, instead of spending 2 hours watching CNBC every day, why don't you go to YouTube, Google Joel Greenblatt, watch a video of him? The chances are you learn a lot more. You'll be a lot richer at the end of 12 months than by sitting and watching news channels. Okay. The third thing is One Up on Wall Street, Peter Lynch. The story about Peter Lynch is Peter Lynch for a 13-year period, he ran a very successful fund called the Magellan Fund for Fidelity Investments. Now, the Magellan Fund returned close to about 30%, between 29 to 30% per annum over a 13-year period. I think it was 1977 to 1990. For those who have been in the market, that kind of a track record is unbelievable. It is absolutely extraordinary. I mean, I don't know of anyone who has sort of done that. To the best of my knowledge, I have not sort of come across anyone. But if you read the book, sort of One Up on Wall Street, he wrote that book to educate ordinary Americans that you can actually beat Wall Street. And he was not joking, in the sense that he did not write it for fun. He wrote it basically to tell people that you can be better than them just by getting a few sort of, by getting a few basics right, by getting sort of interested in a few things. And this book is very, very readable, in the sense it's a very interesting read. I think, again, it's less about finance and about psychology, in terms of how did Peter Lynch actually go about, picking stocks? Why did he buy some? Why did he sort of, not buy some? What was his strategy? Written in a very simple, very understandable language, and very, very interesting. So there is a lot of, again, sort of, you can even listen to Peter Lynch, nowadays because of YouTube and all, you can, even get YouTube videos. These are the things, if you want to be what I would call as a serious investor, probably these are the things that you should, among other things, these are the things that you should be listening to. So even a talk by Peter Lynch, maybe it's I think maybe 45 minutes to an hour's video. Frankly, that would be worth a lot more than sitting and reading, 20 different articles on how things will pan out. I mean, I have a lot of respect for people who have written that, but if you ask me as an investor, I would rather listen to a 1-hour video by Peter Lynch in terms of how did he actually pick stocks, where did he go right, where did he go wrong. You will also see a consistent theme in all these people is the first thing that they say upfront is, we made a lot of silly mistakes. That is the very first thing that they say. In fact, Warren Buffett, many times people ask him that, what were your mistakes? And his answer is, where do you want me to begin? I have made so many sort of investing mistakes. And he said, it's not the things that I did right that cost me. It's the things that I did wrong that sort of really cost me. And the things that I did wrong, he says, were things where, not that I did not know. He said things which I knew about, but I did not do anything about it. So, for example, if you say that, look, I don't know how technology companies work, that's fine. You don't have to know about them. The investment market is made up of hundreds of thousands of companies. You pick your country, you pick your market, you pick your sector, you pick your company. You only need to get 5 out of 500,000 companies right. That is it. You don't need sort of anything more than that. So this is sort of what they also call as a circle of competence. Circle of competence means that don't go fishing in areas which you don't know anything about. And I can absolutely guarantee you this is what 99% of investors do. It's because of the nature of my work, we have to go to a lot of events, functions, parties, whatever. People are throwing out stock names, stock ideas. Again, with a lot of respect to those people, 99% of them are completely wrong. Okay. But it's just people like to sort of do it. But what I'm saying is listen to it, enjoy the conversation, have a good evening, but don't go and act on that information. Then you'd be sort of making a very big mistake. Rules of investing, sort of very simple. Okay, again, very simple, but not very easy. And I'll tell you I'll explain to you why this is, not that easy. Okay, first is, let me start with the lady on that side. How many of you Okay, how many of you do not recognize her? Or how many of you recognize her? Okay. So, Anna, you do this one. Okay. So, Whitney Houston, yeah. So Whitney Houston, again, the reason why I picked Whitney Houston was, one is because, she's come to Hong Kong, we have heard her. In fact, one of my earliest memories in Hong Kong was Whitney Houston, again, sort of, sadly, I mean, she was worth more than $250 million, more than $250 million. She died almost bankrupt. Okay, that was sort of, that's one example. I'll come to the one in the middle a little later. The last person probably all of you would recognize, okay, sort of Mike Tyson. Again, sort of Mike Tyson has come to Hong Kong. He's spoken here also. At one point in time, I'm trying to remember when, maybe in the mid-90s, if I'm not mistaken, Mike Tyson's net worth was estimated by Forbes to be around about $625 million. Okay, $625 million, which means that he was in the running to be a billionaire. Because if you're worth $625 million in the mid-1990s, you should have reasonably expected to be over $1 billion, say, over the next 30 years or so. Mike Tyson today is currently worth, again, sort of, if you Google it, you'll get various estimates, but roughly there'll be around $8 to $10 million. Created sort of enormous wealth. Now, the thing is, you would say, look, how do you expect, they are not professional investors, right? I mean, how do you sort of expect them to maintain their wealth, preserve their wealth? The point that I'm making is being able to maintain, preserve, grow your wealth, even as students, has very little to do with knowing sort of what investing professionals do. It has everything to do with psychology. So whether you grow your wealth significantly from an investing perspective over the next 5, 10, 15, 20 years will have very little to do with your sort of brain power. It'll have everything to do with your psychology. All of you sitting here are more than qualified to be multi-millionaire investors. Whether you'll actually get there, I think, will depend on your psychology, not on your sort of, your brain power, your financial skills or whatever. Okay, so that is, again, sort of people who made extraordinary wealth and who lost it. What about the people in the middle? Okay, does anyone recognize the people in the middle or whatever? Okay, again, not sort of, would be more well-known, not really sort of well-known. They weren't celebrities or anything. They are the sort of Hunt brothers. Now, these were sort of, in the US, in Texas, the Hunt family, they were like sort of, they made their money in oil. They were billionaires. And the father basically made his money in oil. The sons were very astute, very smart investors. And what they did was, in the sort of 1980s, let me just get the exact date here. They took the view that the world was entering a high inflation phase. So look at it, for example, today. Okay, today people say, look, it's very inflationary. Prices are going up, high inflation, buy commodities. The psychology has been, when you have inflationary periods, you try to buy something which preserves value. During inflationary periods, money doesn't preserve value. Maybe gold does, maybe silver does. What the Hunt brothers did was they started systematically buying up silver because they took the view. Now, again, remember, these are very reasoned, intelligent, sophisticated bets. These are not just random bets. The Hunt brothers probably had a team of, specialists working for them. They took the view that inflation is going to go up. The price of silver is going to go up. We need to make a killing on this. So they started cornering silver. They started buying up whatever silver they could. Now, over a period, at one point of time, at their height in around 1980, they had almost 1/3 of the world's silver. That is a phenomenal quantity. Okay, and this is including silver held by central banks and so on. So their strategy was, let's kind of corner this market to the extent that, again, I don't want to bombard you with slides. Tiffany had put out a full page advert in the New York Times accusing the Hunt brothers of making it difficult for Tiffany to service their customers. Because Tiffany said, if the price of silver goes up so much, we have to charge our clients 5, 6, 10 times what we normally charge them. And the clients are kind of getting furious, saying that what's wrong? I mean, you can't just ramp up jewelry prices like this. But the reason Tiffany said we have to do it is the Hunt brothers have taken all the silver from us. We have no silver left. How are we going to do this? So the Hunt brothers made a very calculated bet that the price of silver will go up. Now, in a sort of short period of time, I'm trying to get the exact dates here, but basically in a sort of so we are talking of the period, so in a 1-year period, so literally from sort of, 1979, 1980, 12 month span, Jan 79, Jan 80, the price of silver went up from about $6 to close to $50, about 49 point something. Okay, so the price of silver went up enormously. Now, what happens? Now, I want you to think of this and compare it to, say for example, what happened in crypto last year, 2022, because that is something which you might be more familiar with, which, I'm hoping a lot of you weren't into crypto trading. If you were, I'm hoping you did make money. You weren't sort of on the losing side of the trade. Okay, but anyway, sort of say something similar to crypto or whatever, where basically what happened was, in a very short period of time, the price of that asset went through the roof. Now, every time an asset climbs in value, the excitement in the market goes up, right? Because you naturally expect that when silver went from 6 to 12, people said, wow, it's doubled. When it went from 12 to 24, the excitement was enormous. People who went it at 12 said, we have made 100%, we have doubled our money. Should we exit? No, we shouldn't, because from 24, they said maybe it'll go to 100. Right? In reality, nothing ever does. But that is the way sort of nobody really knows the bottom, nobody really knows the top. What mistake did the Hunt brothers do? The mistake the Hunt brothers made was they didn't buy the silver with their money. They bought it with borrowed money. So the Hunt brothers were borrowing from whoever would lend to them, and they were buying up all the silver in the market. So the next question you might ask me is, why were people lending money to them? The thing is, in the real world, nobody knows your exact position. Nobody really knows what a person is exactly worth. So as an example, when the Hunt brothers would have been, say, negotiating with 10 banks, and I can give you so many examples of this thing repeated over the years. It's like, that's why I say history is so important, because people never learn from history. Institution A, Bank A, whatever, had no idea what Bank B was doing. Bank B had no idea what Bank C was doing, and so on. The Hunt brothers were negotiating separately and individually with everyone. And they were sort of almost kind of, okay, if you're not going to give me the deal, I'll walk somewhere else. Okay, without taking the names of institutions, there were a lot of very significant institutions, which I'm sure you'd be all aware of, which were massively involved in leveraging up the Hunt brothers. Okay. As with any asset class, what happened? What happened was, when the price started going up rapidly, at some point, the price went from 6 to 45, and then it started climbing down. When it started climbing down, naturally, as with any other asset, the banks came margin calling. Okay? Are you familiar with the concept of margin calling? Maybe I'll get into that a little sort of. Margin calling is basically the bank said, well, hand us over our money. We have lent you so much money, we want it back. And, the Hunt brothers said, well, we'll give it back to you, but just wait. We'll give it back to you after a few months. What's the hurry? It was well known that their name was as good as gold. Why would anyone not lend to a billionaire, right? If a billionaire asked for money, why would any bank not lend to the billionaire? So the banks had all lent, the banks were all heavily leveraged, the Hunt brothers panicked, they started dumping silver, the price of silver started collapsing, they started dumping even more. So you had a sort of very vicious cycle on the way down, to the extent that the billionaire brothers declared bankruptcy after a few years. Very smart investors, very well informed, did all the research, they were the best of the best. The problem was they ignored a very simple rule: don't leverage to the skies. And this was 1980. I'll give you many, many more examples later where this happened again and again and again. 2022 was a year where sort of as a banker, we saw lots of margin calls where we had to, unfortunately call clients saying, please return the money. Okay. And this happens every year, because typically what happens is people borrow on the way up. When the market sort of reverses, then it becomes very difficult. So what I would advise you as students is, when you sort of set about investing, try to keep these simple principles in mind. Leverage sort of doesn't pay. If you ever think of doing it, be very, very careful. It's a very sort of dangerous game. We warn investors all the time, and still sort of it keeps on happening. Okay. So the mistake that the Hunt brothers made purely was, they may have had $1 billion, but they borrowed another 10 billion. So they went way over their heads, and they paid the price. This incidentally is, it's not sort of my quote, it's not my rule. This is again sort of what Warren Buffett always mentions, saying that there are only 2 rules to investing. The first rule is that never lose money. The reason why they say never lose money is, again, like I said, your maths is much better than mine. So you can probably tell me this, you can explain this to me. If you have $100 and you lose $20, okay, you're down to 80. The problem is, to get back to normal, you don't need 20% now, you need 25%. Okay. The maths gets very difficult as you go down the curve. If you go from 100 to 70, and I can guarantee you plenty of investors go from 100 to 70. I'll give you a few examples later, not of the investors, but of the stocks. 100 to 70, you're down 30%. The problem is, to just get back your capital, you have to be up almost 50%, right? So the maths is very bad on the downside, is really bad on the downside, and so on. If I remember correctly, Facebook fell close to 25% in a day. 25% for a stock with a market capitalization that high, it can give heart attacks to investors. It's not a 5% correction, it's a 25% correction. Okay, and these are market leading, world-class companies. So, be prepared. You will see a lot of this going ahead. Companies which you think are sort of, invincible or cannot happen, I can absolutely guarantee you it's going to happen when sort of we all least expect it. What we would call as a black swan event, something sort of completely sort of unexpected. That means even if you invested in the best 100 sort of technology companies, listed and so on, you would, without leverage, again, I'm talking about zero leverage, you would have a third of your net worth wiped out. Okay. And if you sort of go in with leverage, you can do the maths. It'll be even more scary. But the point that I'm making is, you take a long-term view, you play it steadily, you stick within the basics, you will almost certainly beat the market. Even if I cannot guarantee you that you do very well on an absolute return basis, I can absolutely guarantee you will beat the market. Because most investors, I have seen so many portfolios, so many accounts, so many clients. I cannot even count on the fingers of one hand. I can't even reach 5 clients who have beaten the index. It is very difficult to beat the index. If you go to a party, if you go to a function, I'm pretty sure you'll meet a lot of your friends who'll say they've beaten the index. They know people who have. Take it from me. I mean, I've seen we handle bank accounts, so we know you can't beat the index. It tells me I lost, say, 8% last year. I would actually tell them, look, leave your business and do investing. Because frankly, you're doing something which is extraordinary. It's like saying I played a tennis game and I can actually, beat Djokovic at tennis. Then you should be playing tennis. You shouldn't be doing anything else. It is, if you want to benchmark yourselves, the simple thing to do is take the S&P 500 1st Jan, 31st December, see how it fared. Take any year you want, any time period. Look at your portfolio, see whether you've done better or worse. That is the sort of best benchmark. It's the simplest benchmark. It guaranteed sort of won't fail. I have specifically presented this because I want to, okay, this is sort of, 98. I mean, 98 was when the collapse happened, but 94 to 98. This is when sort of, I was working at that time. My chance, I'm guessing most of you are probably in school at that time, maybe primary, secondary. Some of you might have just started working, whatever, but this is 98, 94 to 98. You don't have to read this particular book. This is a book that was written about long-term capital management. Okay, so you can Google long-term capital management. You can look at it up on the internet. You can read a book if you want about it. But this provided a lot of very valuable lessons. Very, very valuable lessons. And it's quite interesting because the name is long-term capital management. Okay, long-term capital management didn't even last for 5 years. It didn't even last sort of long-term. Okay, but the name was long-term capital management. Why do I say when genius failed? If you look at, I'll tell you later about the people behind long-term capital management. It's like assembling, I don't know how to make a sports analogy, whichever sport you're familiar with. There was no better team in investing. This was really the best investing team that they could put together. It was like a collection of geniuses. So if you put together the best minds in investing, that was LTCM. So it was really, that's why the article is when genius failed, because really genius did fail. So for example, LTCM, one of the founders was John Meriwether. For fixed income investing, for fixed income traders, John Meriwether was the super gold standard. Okay, John Meriwether headed the bond trading desk at Salomon Brothers. If you read any of these books, sort of, in terms like, whatever, Barbarians at the Gate and so on. So these are books which talk about, bond trading in the 1980s and the 1990s. John Meriwether was really a legend in the world of fixed income investing. Nobody understood fixed income markets better than him. He was the sort of best guy. The other people, these are all the people on the board. There was Robert Merton, Nobel Prize winner in economics, finance sort of genius. Robert Merton is, well known in the field of finance. There was Myron Scholes, again, Nobel Prize winner in economics, renowned sort of economics, renowned financial engineering. These were real sort of superstars. The fourth person on the board was a person who was at that time, the vice chairman of the Federal Reserve, David Mullins. And David Mullins, actually, the thing is, the name might not sort of ring a bell, but this is history. David Mullins was supposed to have taken over from Alan Greenspan. Okay. Well, what happened was history in the sense the world remembers Alan Greenspan. We'd all wonder who is David Mullins. David Mullins was again sort of was on the board of directors of LTCM. LTCM had really a star cast, and they had everything going for them. They did very well. They understood what they were dealing with initially. Okay, later on, sort of we'll see sort of how they kind of went astray. We'll get into a little detail. So why genius failed? What investors ask is, how did they not know the basics? How could such smart investors trip on such basic things? That is what sort of, astounded investors. The kind of people who invested in LTCM were the smartest investors. Even central banks sort of lent them money. There were, pension funds. There were university endowments. Everybody was fighting to give money to LTCM. Because if you looked at the kind of the roster of LTCM, you said, wow, I want to give money to these guys. Okay, so that was sort of it. And again, sort of what can I as an investor, learn from this? What are the lessons to take? LTCM is something that has been sort of repeated again, it will sort of, in your investing lifespan, guaranteed, you're going to see quite a few LTCMs. You would sort of, if you make any investment, they always say past performance is no guarantee of future returns. This is something which you see in advertisements. Whenever you sign on any document, you'd always see this. This is something which I would urge you to kind of, seriously embed in your mind. Very truly, past performance is no guarantee of, future. I can absolutely sort of guarantee you that, And the reason is because all the sort of dynamics will change. So for example, LTCM's returns were very good. They started off in 94. Almost in no time, they had collected $1 billion because $1 billion in 1994 was a lot of money. It might not seem so much in 2022. In those days, it was a significant amount of money. People were very keen to give them money. They had a very good track record. They had sort of everything going for them. It's not that they were cheap. They were taking, you might have heard this 2 and 20, where sort of funds sometimes charge 2 and 20. 2% is like a recurring 20% of profits. So the 2 and 20, they were in fact charging even more, 2 and 25. People had no problems giving them that money because every year they were delivering spectacular returns, 94, 95, 96, 97. Now, what actually happened was LTCM was investing in a lot of different sort of strategies, styles of investing. It became so complicated beyond a point that nobody really understood what was going on. And because the people involved were, at that level, they themselves were almost afraid of saying that we really don't understand anymore what is going on. The trades became extremely sort of complicated. Very, very complicated. So LTCM started off on a very simple basis. They were simply trying to find out sort of bonds, looking for sort of bonds where the spreads had diverged due to something which was would be sort of course corrected and the spreads would converge. So basically the fundamental ideas were very simple. But they started, as they sort of progressed, they started putting up more and more complex trades to a point where they lost sight of the picture. To give you an example in very practical life, I get a lot of calls like this. So for example, Friday evening, a client would call me up and say that, I've heard of this stock, should I invest $50,000 in it? Okay, that's the question. Now, how do you think, what is the answer to that? Okay, forget the stock, how would you answer a question like that? Somebody just called up and said that, okay, this is the stock, should I invest $50,000? Okay, anyone wants to take a guess? Doesn't matter. There's no right or wrong in investing. Don't worry. There's absolutely no right or wrong. There's nothing that I say is the answer. Okay, so what I tell them is, I say, look, what part of your portfolio is this? So what I mean is, you are telling me you want to invest 50,000. Okay, that's fair enough. Is your portfolio 5 million, 50 million, 500 million? How much is your portfolio? If this is less than 1% of your portfolio, you are wasting your and my time, right? If it's less than 1% of your portfolio, do whatever you want. What difference does it make? Is it really going to make a difference to you? Right? Or maybe you are asking the question just for fun, just to get an opinion. If it is more than 1% of your portfolio, maybe we'll think about it. If it's more than 2% of your portfolio, let's have a discussion. If it's more than 5%, wait, don't do anything. We'll talk on Monday. Right? So the first question I ask them is, what part of your portfolio is this? I mean, is it relevant to you? In a lot of times, the answer is no, it's not relevant. I've had lunch with a friend and he said, you should really be doing this. So what my answer to them is, just do whatever you want, right? Yeah, I mean, because it really doesn't sort of matter. Is it going to change your car? No. Is it going to change your house? No. Are you going to send your children somewhere else to study because of this? No. Is it going to make any difference to you? No. Then why are you asking me? Right? It should. So what I'm trying to tell them is it sort of material? Is it a material trade? Okay, that is the first thing you have to understand. Is this trade a material trade? So anyway, coming to LTCM, they went up to here. What LTCM didn't account for is what I would call as not the unaccountable, but the very, very rare sort of black swan event. Okay, now what is the black swan event? The black swan event, what happened later was, okay, one was the Asian financial crisis unfolded over a period of time. The other thing was Russia defaulted. Okay. Now, what is so great about a sovereign default, you might say? Yeah, I mean, countries sometimes are unable to repay their debts. That was not the interesting part. The interesting part was Russia defaulted on their local currency. What does this mean? This means that they didn't have enough of their own currency to pay. Okay. Now, the answer to this is, you would say, look, why didn't they just print it and pay it? Right? You can default. So what I mean is, let's say, for example, okay, again, sort of hypothetical. Okay, this will never happen to Hong Kong. But let's say, for example, say Hong Kong needs to repay Hong Kong dollars. They can just print Hong Kong dollars and repay. Okay, Hong Kong is not a good example because say it's pegged and it has other restrictions. Whatever, say Singapore, say Thailand, say Malaysia, any country. If it's a local currency loan, you just print it and repay it. What's the problem? But Russia was not even in a position to print it. So they had to sort of default, and international debt was another sort of, another issue, but they could not even repay their local currency debt. This had not been taken into account by these guys, because these guys were so sure of their calculations that they sort of forgot to calculate that you can even have a local currency debt. They said, how is this possible? You can have a foreign currency debt. A country might not have a foreign currency to repay. How can they not have their own currency to repay? It doesn't make sense. In investing, the insensible or whatever, the unthinkable will actually happen. You can sort of take it for granted. Okay, and sort of compounded with other things. So that is one reason. Okay, a very rare black swan event. Again, never happened before. Once in 50 years, cannot happen. That's why I keep saying past performance, no guarantee. Very, very rarely has anyone defaulted on local. In fact, to my knowledge, I don't know of any reasonable government that is defaulted on local currency debt, because you simply print and pay. You can print as much as you want. The printing presses are your own. Okay, very unusual, but it can happen, and it costs them badly. The other reason what cost them is, in terms of leverage, again, you have to be very careful about handling leverage. The best of investors get it wrong. Now, a thing like LTCM, for example, they realized that they were sort of running on a high leverage, which is why at one stage they did the right thing, where they returned some sort of capital back to reduce the leverage. The leverage was still 25-1. Okay. Now, the story didn't end at 25-1. When the Russian crisis, when the Asian financial crisis took place, at that time, the assets of the company, I'm not counting the leverage, the assets were about 400 million. The leverage at that time had exceeded more than 250 times that. 250 multiplied by 400 million, which is what they had borrowed. That is when the phone call went to the Federal Reserve, went to Warren Buffett saying that, please, can somebody help to bail us out? And the first question that the Federal Reserve asked is, what were you guys doing? 250-1. This is 25-1. I'll give you the date for that one. In September 98. So Russia defaulted on 17th August 1998. And by next month, which is when their asset base minus leverage was reduced to 400 million, they were sitting on debt of more than 100 billion. How could such smart investors have made mistakes like this? This is why I say when you're looking at it, it's so difficult to have a track record that is consistent. The reason why millions of ordinary common investors listen to people like sort of Warren Buffett is because they have a 40-year track record. It's really difficult to do that. You can have spectacular track records over a shorter period of time. I showed a slide earlier about Peter Lynch, One Up on Wall Street. Amazing record, but sort of 13 years. So, I mean, not short, but reasonably short. But some of the other investors who have done it for decades and decades. That is extremely difficult to do. Very, very difficult. I don't know of a single person who has beaten the S&P 500 consistently over a 15-year period. I don't know of anyone. If you know of someone, let me know, because I would like to meet that person. Nobody I have met in my life has beaten the S&P 500 for over a 15-year period. It is that difficult. That's why I say stick to the basics. You'll be absolutely fine. You'll beat 99% of the market. You might not be an absolute outlier, but it doesn't matter. You'll be way ahead of every other investor. So the LTCM saga was like a sort of wake-up call, saying that there's too much leverage in the market, you need to control it. Did the markets actually learn anything from this? Probably not, because then you had the internet bubble happening just after that, 99-2000. I remember attending a party in Hong Kong. I think it was somewhere in 99. I can't remember. This was it was held at the Grand Hyatt. I forget the name of the company also. If I remember correct, it was pets.com or something like that. Okay, a lot of hype. That company was going to go places. I don't think it even lasted 12 months. I'm pretty sure it didn't. We had people who left, where they were working to go and work for that. So I have, I don't know when you see these cycles in investing, one of the things you realize is that they will sort of happen again, which is why I tell you, as investors, if you really want to be a good investor, you don't need to do more than two to three trades in a year. That's it. 2 to 3 trades. Even if you can identify 2 to 3 good trades in a year, you are actually very good. You will do extremely well. So for example, last year, 2022, say what might have been one of the trades? Say, look at the pound. The pound fluctuated about, close to 40% within 12 months, very short period of time. You would of course say, look, how would I know? How would I know when the pound was at this level to buy? How would I know whatever? Of course, you will not know. But there are times when your conviction will tell you that there is something unusual in the market. I can, as students of finance, as MBA students, I can tell you one thing with certainty: maths is never wrong. If you actually respect the maths, guaranteed you will do extremely well. So what do I mean by that? What I mean is, today as we speak, on a mathematical value, guaranteed US markets are overpriced. Okay, you can argue it any way you want. Okay, you might argue that, look, they are not overpriced, they could go up 40% more. You could be right, but the mathematics of it is correct. On a valuation basis, if you ask me, is the Nasdaq 100 undervalued or overvalued? It is overvalued. Is the S&P 500 undervalued or overvalued? It is overvalued. Okay, this is the maths doesn't lie. It's like the Titanic. Once the maths works against it, the Titanic will sink. We can sit on the deck of the Titanic and sort of fight till we both kind of sink in the water. Okay, but the maths of it will not change. If you want to answer any question in investing, look at the maths always. The maths will never sort of be wrong. Okay, so for example, a stock like Procter & Gamble, everyone sort of knows Procter & Gamble. It's as a company, maybe sort of not as a stock, whatever. Procter & Gamble is considered as a value stock. People buy Procter & Gamble products all the time. We can't live without Procter & Gamble products. It'll go up over a period of time. It gives you dividends, great stock. Procter & Gamble today is trading at a PE of just something in the mid-20s. Okay, that is not a value stock. Okay, that is not a value stock. A value stock should be trading at 5, not at 25. But the market sees it. So what I'm saying is, the best way to do well as an investor for each one of you is ignore all of us, ignore me, look at the maths. What is the maths telling you? The maths will never ever be wrong. There was a time last year when the Hang Seng Index was trading at a ridiculously low PE. The maths was very correct. It sort of rebounded from that. Now, whether, we could have sat and argued for the next 2 hours over what will happen over the next 12 months. You could have been right. I could have been right. No one could have been right. Whatever. The maths is not wrong. That is that's the basic of investing. The reason why, these investors, I keep going back to Warren Buffett because that's just it's a person I follow, whatever, but you can sort of choose your own idols or your own, whatever you want to follow. The reason why they do so well is because they look at the facts, they look at the numbers. They don't really, bother about the arguments. I mean, you can make all the arguments around the numbers. Okay. But every market, every asset class, I can guarantee you has what I would call as a sort of fair value. And that fair value is the fair value. Whether I like it or not, you like it or not, it's not going to make a difference. Accept that, recognize that, and try to sort of take it in your investing. You will almost certainly do well. Okay. So again, from a valuation perspective, the US dollar today is very much overvalued. Does it mean that it can't get any stronger? Who knows? Maybe it could, right? But if you ask me, mathematically speaking, where does it stand? It's overvalued. I would say that anyone sort of will say that from a valuation perspective. Go for the valuations. You'll very, very rarely be wrong. Okay. A stock like Tesla, again, sort of, I'm not recommending this either way, buy or sell. A stock like Tesla was trading at a price earnings of more than 100. Okay. Now, again, somebody might say, look, I'm a growth investor. I've invested in stocks with P's of 200 and I've done very well. Fine. I mean, good luck to you and I'm very happy for you. But is this something that you can repeat and do well over a period of time? I really doubt it. 100 to 1 price earnings ratio tells me that either there is something a little strange about this. Either the person who is proposing it knows something really that's extraordinary, or they are completely wrong. So as a general rule, remember this: investing is not an argument game. Go by the maths. You'll do very well. This works for every market. It works for sort of every asset class. At the beginning of last year, Jan 2022, fixed income was expensive. This was an indisputable mathematical fact. It was expensive. If interest rates had gone up even slightly, it was going to hammer fixed income. Mathematically speaking, this was going to happen. And it did happen. Interest rates went. See, again, the thing is, look at the maths. When you say interest rates went from, say, last year, so January 2022, the actual borrowing cost of clients was roughly around 0.5%, very, very low. Okay, clients were getting sort of free money. Generally, the world was operating on free money. People borrowed up to the hilt. Within the span of 12 months, borrowing costs for the best borrowers has gone up to roughly around 5%. Now, the thing is, it's not the 0.5 to 5. It's a factor of 10. It's a factor of 10. That'll hit you. That will sort of hit you. So it's not that when it goes from 0.5 to 1, it might seem as it's just gone up 0.5%, but the hit to the bottom line is enormous. We see this sort of happening every day on a daily basis. We see clients losing sleep over it. We see sort of much worse things. We see, margin calls and so on. That's why I sort of tell you, you're at an early stage, you're starting off, you have all these advantages. So, learn from it and you'll do much better than that. This is really the top of the slide actually is market cycle psychology. This is a cycle which you would see time and again very, very often. Okay. Now here I would sort of need a bit of your help. This is just a general chart. Where are we currently on the chart? So let's say, for example, take the Hong Kong market. That's probably what you'd be familiar with. Where the Hong Kong market is concerned, where do you think are we? Are we here? Are we here? Are we sort of out there? Are we kind of here? Where do you think we are where Hong Kong stocks is concerned? If anyone would like to take a guess. Remember, your guess is as good as mine. There's no answer here because it's really for every investor to think about it. In the sense, as an investor, do you think we are here? If you think we are here, of course you should invest. Naturally, because you're seeing a sort of, in your mind, you're seeing a road ahead. If you see yourself as here, if you see the market as here, don't invest because you're sort of seeing it going down. But typically what happens? Say for example, last year, maybe around, what is the bottom of the market? Maybe September, October last year. It was something almost like disbelief, where the feeling was that, look, nothing is going to happen. Things are like really bad. We are not going anywhere. Then you got a little bit of hope, that things would open up. COVID is getting better. Optimism where, yes, now we are on the road to recovery. It'll still take some time, but we are kind of out there. And then people start what I would call as chasing the market, saying that let's get in. Now we really need to invest. The markets are going to climb up. Now what happens was, crypto is a good example because within the space of 12 months, crypto went from sort of here to here. Okay. So crypto, I don't really, I don't follow crypto that much. I don't know anything about crypto. So I'm far from an expert. The only reason why I track crypto prices is because clients invest in crypto. So Bitcoin, for example, there were clients who got in at, 5,000, 10,000, 15,000. The thing is, nobody really knows at what level to stop. So the person who got in at 5, 10, 15 also got in at 60,000, 65,000. The peak I think was somewhere around 65,000. Again, you probably need to, check it on the financial, but it was somewhere around 65,000. So you are sitting on a sort of pile, but So 65,000 is basically euphoria where you say, look, we are all going to be rich. The other thing that I would, exhort all of you is, in investing, keep a sort of distance from you and the market. If you beat the index, don't ever feel you're good. If you don't beat the index, don't ever feel you're bad. It's a lot more complicated than that. So because euphoria is, this. So basically, Bitcoin at 65,000 was euphoria. Okay, and similarly, other sort of stocks, whether it was internet stocks at that level, was euphoria. I mean, I know it's going back many years ago. Two examples I'll give you because you might be familiar. I know sort of clients who have bought Yahoo from $10 to $230. Okay, and 230 again, sort of this I'm taking off the top of my head, but I think it had probably fallen to 6 or 7. I'm not sort of sure where it ended. Okay, Yahoo at that time was amazing. I mean, I remember the first time someone came to me and said that I'll open an Hotmail account for you, and you don't need to post something. You can just send it like that, and it was amazing. It was extraordinary. I said, wow, how can anyone do something like this? Technology has sort of moved on. Companies have moved on. So these things will change. The markets will keep on getting these things. So for example, say last year, at some level, the anxiety kicked in, where people said, look, markets are falling. What do we do now? Do we buy? Do we sell? Sort of, do we hold on? What do we do? The only way to get out of all this is to basically, invest. I would say one is, of course, no leverage. The second thing is, don't ever think you're going to beat the market. So invest with that thing at the back of the mind that you are not going to beat the market, and invest accordingly. What I mean by that is, invest in something which you are prepared to hold on to at least for 3 years. Because in that period of time, it's like a roller coaster. You're going to see things, really sort of go down. I mean, I've seen sort of markets, swing sort of wildly, absolutely wildly, and people actually panic when it happens. So we saw this with Brexit. I remember a conversation where this was with Brexit, and this was maybe about 6 months before Brexit happened, maybe 3 to 4 months, where actually a client told me, she said, look, Brexit is going to happen. And my answer was, I said, it's impossible. There's no way. Why would Brexit happen? No one wants Brexit. I was completely wrong, right? It happened today. Sort of the world regards it as the world has sort of gone beyond it. Okay, so what you might think as, there's no way this can happen, it can happen, the world sort of goes beyond that event. The market will keep on. Capitulation is basically when sort of you have panic and then you have capitulation.